So turn on my annotation here so you can see where I'm pointing at. This slide talks about the attributes of conventional funds in the middle and corporate class funds on the right. And those, attributes also apply to directly held securities, apply to ETFs, which are essentially mutual fund trusts with very few exceptions. And the way to think about this slide is think about a global balance type of investment fund that is invested in Canada and around the world and will earn the various types of interest, including interest and dividends, et cetera. And as a trust, it's a flow-through vehicle. It will make distributions out of those different categories because otherwise the trust is actually taxed itself. So by making those distributions, the tax shifts to the investor. And for taxable accounts, and that's what we will be focusing on today, the investor gets a T3 slip and reports these items on their tax return as if they'd earned them directly. So interest and foreign income, fully taxable. Canadian dividends with our gross up and tax credit that reduces the tax impact. So we call it tax preferred in nature. And capital gains with our 50% inclusion rate. I should also note that investment funds, of course, pay fees, and those fees are deducted by the fund prior to distributing these other four types of income. So investors do get the benefit of the tax deduction. Over to corporate class. Well, we do have a check mark against Canadian dividends. Now, similar concept here. The corporate class fund will pay out the Canadian dividends it has earned to the investor. It will show up on a T5 slip, and it'll be taxed as if they'd earned it directly themselves. So again, tax preferred in nature. Capital gains, again, we've got a check mark there. So they will show up on a T5 slip, 50% inclusion rate. We do say potentially less than trust versions. Historically, this has absolutely been the case. Going forward, we expect this to continue to be the case. In any one year, though, all bets are off. There are significant timing differences between trust versions of funds and class versions, meaning that you can't just take this as a blanket statement that will apply every year. That's not the case. Importantly, we do not have check marks against the top two items. As long as we're careful, we will effectively have those items earned as capital gains. Now, of course, that sounds pretty good, right? I always encourage you to be, a bit skeptical when anyone is pitching you something as being tax advantage like this. What are the tax risks, right? How does it work? And the tax risks, I put those into two buckets. Firstly, the CRA disagrees with how we're reporting it, right? Because, they think that we've misapplied the rules in the Tax Act. And that can either be directly or CRA also has another tool called the General Anti-Avoidance Rule, GAR, which if they disagree with, the end result, they can use GAR to basically reassess. Now, the good news is with conventional corporate class structures like Fidelity's, the risk of a reassessment is virtually zero. The risks I should mention is that they change the rules because CRA is always looking for loopholes. Every year when they come out with a federal budget, there are always loopholes being closed, right? I'm not talking about investment fund loopholes. I'm just talking about in the general, tax world. They will close down loopholes with regularity. But they haven't closed down corporate class, right? And they don't perceive it as a loophole. Right? So even though we get to say, hey, you get to earn interest income, but have it taxed as a capital gain, they don't perceive that as a loophole. And it's not that they don't understand corporate class structures, by the way, right? And going back to that audit risk, they have audited corporate class structures, including Fidelity's. They're very, very familiar with corporate class structures, and yet they've left them in place. Why? Well, to get to the answer to that, we have to look at the mechanics. So that's on this next slide here. And I will, of course, use Fidelity's corporate class structure as an example, but these mechanics apply across the industry. There are actually about a dozen corporate class structures with assets of at least $1 billion, the largest of which is Fidelity's. but there are other large ones out there as well. So we have a November 30 year end. Different corporate class structures have different year ends. When we get to that year end, we look at each of our corporate class funds. We actually have 89. But they're all within one corporation. So we basically add it all up. Right? And ideally, what we will have are sufficient expenses across all of those 89 investment funds to fully offset all of the interest and foreign income earned, again, across all of those 89 investment funds. Because if we don't have enough expenses, here's where we can run into an issue. That interest and foreign income, remember, it's not going to show up on a T5 slip for your client. Instead, it's what we call trapped and taxed within the corporate class structure itself. The class fund that your client is invested in can end up paying some income taxes. That will act as a drag on performance. Right? Now, a little bit's not a big deal, but as it grows, it starts to degrade the benefits of corporate class. Even there, right? For a client in a high tax bracket, they still end up better off in the corporate class structure. Right? Now, the good news is Fidelity's corporate class structure has never had to write a check to CRA. Right? We will not have to for our year ended November 30, 2025. But let's say interest rates go up a little bit and we do end up paying some income taxes, right? Even there, as an investor, and I own a particular class fund that several, but I'm going to talk about one in particular. I own it in the class version. I don't own it in the trust version, and this is, again, in a taxable account. So if that class version ends up paying, let's say, 20 basis points of income taxes, okay, my return is lower. However, if I'm in the trust version, right, that trust version will be issuing a T3 slip that has even more fully taxable interest income because interest rates have gone up. So on an after-tax basis, I might look even better. My tax savings might be higher because I'm using the class fund, even though the class fund is paying some income taxes. And this has to do with why I believe CRA has not shut down corporate class. They know we have a choice. Different fund companies have different approaches to corporate class structures. Right? At Fidelity, call it conservative. We tend to make our decisions based on what's right for the existing investors. So, as an example, you cannot buy a bond fund in Fidelity's corporate class structure. Some of our competitors, I don't know if you can anymore, but for a period of time, they had bond funds open for new investment, so money flooded in. Well, the problem with a bond fund, of course, is it's going to earn interest income in excess of its own expenses, leading down the path to this problem of paying income taxes. Right? So we've said, no, we don't think that's right for investors, so you can't buy a bond fund in our corporate class structure. Right? Call it a different philosophy. Right? And again, this is where CRA, they know different fund companies will take different approaches, and our largest competitor, they pay, and don't quote me on the number, but this is public information. I just haven't added up the most recent year perfectly. But every year they write a check to CRA of about $90 million out of their corporate class structure. That's a lot of money, and CRA is happy to collect that money. So again, I think that's why CRA doesn't perceive it as a loophole and hasn't shut these things down. So that's interest and foreign income. Our investment funds will also earn capital gains, of course. There, we're able to look at capital losses of some funds and offset them against capital gains of other funds. There are some other tools that we use, but from time to time, we will have to pay out what are called capital gains dividends. Now, they have the word dividend in there, but for all intents and purposes, it's treated as a capital gain. So the 50% inclusion rate applies. And if you have a client that's a small business owner, for instance, and they have investments within a corporation, a private corporation, OpCo, HoldCo, ProCo, doesn't matter. Again, it'll be 50% inclusion rate, and the non-taxable portion goes into what we call the capital dividend account and can be paid out tax-free to the shareholder. More on that in a few minutes. Now, we actually haven't had to pay capital gains dividends in the last couple of years out of our corporate class structure. We actually pay them in January of each year. There's a neat little rule in the Tax Act that says, hey, as long as we pay those capital gains out within 60 days after our year end, they're considered earned in the hands of the investor. So with our November 30th year end, we pay them in January. We didn't have to pay any in January of 2024. So clients doing their most recent tax returns will have seen, if they have a T5 slip at all, it'll only have Canadian dividends because we haven't paid any capital gains dividends in 2024. January 2025, we didn't have to pay any either. Next year, don't know. Too early to say. And there are significant timing differences between corporate class funds and trust versions. So just bear in mind that there could well be capital gains dividends next January. Now, even there, that's one of the beauties of that timing of it being January is you have a full year to think about tax loss harvesting, right? If a client has a position that's underwater and they've received a capital gains dividend, maybe you want to sell that position, trigger a loss to offset the capital gains dividend to reduce the client's tax bill. And you've got a whole year to think about it. Whereas, if it's paid in December, like a trust version, your client may have already gone to Mexico, right? So the opportunities for tax planning are extremely limited at that time. So that's the capital gains dividends, and then we have Canadian dividends. As I said, they'll get paid out annually. We pay those in May, so if your client buys into a Fidelity corporate class fund today, the earliest they'll have a Canadian dividend paid out is almost a year from now. I'm going to pause there just in case anyone wants to chime in with a question, and then we'll take a look at how this has worked in practice. So I mentioned that there's one particular fund that I hold a fair bit of in my non-registered or taxable account, and that is Global Income. What this slide is showing are the distributions, the amounts that show up on a T-slip of the two versions of Global Income portfolio. Class version on the top, the trust version in the middle. And what you can see is across the years, the distributions have been significantly higher for the trust version than they have been for the class version. And it's an even better story when you look at the fact that the trust version has that fully taxable interest and foreign income line, whereas the class version, of course, does not. Now, you may notice that in 2023, the class version actually paid more distributions than the trust version. Even there, I won after tax, right? Because the majority of the distribution on the trust version is fully taxable, whereas the vast majority on the class version is capital gain, 50% inclusion rate. So I still win. And as I mentioned in January 2024, so for calendar 2024, we didn't have any distributions. So 2024 looked great. 2025 will also look great because when I'm showing you this slide a year from now, there'll be a zero right where my spotlight is. So it really has worked very well. I have saved a lot of tax by using the class version of this portfolio. It's an identical investment mandate, almost identical holdings. There's always a little bit of noise. There have been in the past higher fees, slightly higher fees. But the performance, it's been pretty tight over the years, right? Like, there's 2020. Class version 8.64%, trust version 8.70, 0.06% differential. Now that said, in the last couple of years, we've actually reduced the admin fees on our class versions to bring them down in line with the trust version. So in fact, you can see in 2023 and 2024, the class version actually slightly outperformed the trust version. I'm not suggesting that will be a regular feature, right? But I am saying that going forward, the differential between the returns should be pretty tight. There's always going to be some noise, but pretty tight. And by the way, go back to my comment about if we had to pay 20 basis points of income tax on this fund. Well, again, the way that would manifest itself, the way that would show up is the return. So had that happened in 2024, Instead of 14.12%, it would have been 13.92%. But again, I still would have won on an after-tax basis. So it's worked very well. We expect this to continue to work very well. We have heard rumors that one or two competitors might be shutting down their corporate class structures. Typically, that happens because A, they're into an income tax paying position, which is not the end of the world, right? I mentioned that largest competitor that's paying lots of taxes, and they don't seem fussed by that. And B, the second reason that companies typically will shut down their corporate class structures is because they're small. Right? Fidelity's corporate class structure is not small. We've got over $70 billion of investors' assets in our corporate class structure. So it's actually quite large. Okay. All right. Now, if and when we start to pay income taxes at 20 basis points, or could be more, then we need to think about who's investing in it, right? Because registered accounts get no tax benefit from being in corporate class, none. So if there's a trust version, and many of our class funds do have trust versions, the TFSA, the RSP should be in the trust version, right? Because if we pay taxes, the return will be impacted with no tax benefit to the registered account. They should be in the trust version. Low to mid-income individuals have gotten some benefit from corporate class over the years, but it's relatively marginal. Corporate class is best suited for highly taxed investors. So that's high-income individuals. And I don't know where you draw the line. Could be $100,000, $120,000, $150,000 of income. Or, if they're in retirement, anyone subject to the old age security clawback. Right? Some trusts, it can make sense, depends on the characteristics of the trust and its beneficiaries. Private corporations. I mentioned earlier those opcos, procos, holdcos, right? They are, well, if they're opcos or procos, certainly, if they are low-taxed entities when it comes to their business income. They are high-taxed entities when it comes to the investment income. So let's talk about them, right? They have a more complex world. Your client who owns their own business has to worry about the business and their personal level, right? Why do they incorporate? Well, they get a tax deferral on the active business income. Basically, they might pay, I don't know what the tax rate is. Your clients would be 72, it might be 11%. On the small business income, up to $500,000. So if they earn an extra $100,000, right, that's $11,000 of tax. That's $89,000 left. If they pay it out to the personal level, it goes out as what we call a non-eligible dividend, subject to higher tax than standard dividends at the personal level. It's meant to balance things out. So instead, if they don't need that money at the personal level, they leave the money in there, and then they've got $89,000 left to invest. That's why we call it a tax deferral. And tax deferrals can be very powerful. There can be income splitting opportunities, but these have been curtailed significantly by over the last 10 years by the Liberal Party in Ottawa. We can have succession planning, things like estate freezes. If we're able to sell the shares of the company and meet certain tests, we've got what's called the lifetime capital gains exemption. The first $1.25 million of capital gains per person can be tax-free. Okay? And there's another one called the Canada Entrepreneur Incentive that was introduced in the budget last year. This has not been passed into law. We don't know if it will be because it's complicated and narrow, and it applies on gains of up to $2 million once it's fully in place, but that's a phase-in over 5 years. And the stated intent was to reduce the inclusion rate from 2/3. Remember, last year's budget talked about a 2/3 inclusion rate that's gone away, but to reduce it from 2/3 down to 1/3. Well, if we no longer have a 2/3 inclusion rate, will they go forward with this? We'll have to wait and see. So lots of tax benefits. As I said, low tax rate on the on the business income, excuse me, high tax rate on the investment income. So let's take a look at how that works. We're going to look at a corporation that has built up $2 million of investable capital, right? And that's going to take a few years to get to, but we see this lots of times. And we're going to invest that $2 million in a very conservative investment option, 60% fixed income, 40% equity. Could be balanced income, could be global income, things like that. We're going to assume that the expenses will offset the foreign income, and the Canadian dividend distributions and the capital gain distributions will all be the same, even though that may not necessarily be the case. The class version might have an additional advantage on those capital gains distributions. And we're going to focus on the interest income. So we've got this $2 million. We are looking at 60% of it in fixed income, 1.2 million. We'll assume we earn $50,000. Here's how that's taxed, right? Option 1, conventional. That $50,000 of interest income is fully taxed. The corporate tax rate, I'm using a rounded number here, but in BC, it would be a little bit above 50%. We pay $25,000 of tax. Now, initially, it's only the top 2 lines that matter. So let me go over to the class version. Well, if it's earned as a capital gain, right, only $25,000 is taxed within the corporation. The tax hit is half as much. So moving on, down the road, when the client's into retirement, they'll need cash flow. And we start to pay these amounts out of the corporation into the shareholder hands, right? When we do that, we actually get some of this tax back, right? It's actually a touch more than 30%, but again, rounded numbers to make it easier to look at. We get $15,000 back in this case, $7,500 over in the class version. Add it all up, we've got a $40,000 dividend that we can pay out of the conventional structure. $45,000 can be paid out of the class version, right? But that's not the end of the story, right? Now we have to look at the individual level, the shareholder level, right? So I rolled those numbers forward, the $40,000 and the $45,000. If it's out of a conventional type of structure, it's taxable as a non-eligible dividend. And I'm assuming that they're in the top tax bracket, we'll pay another $18,000 plus of tax, leaving us with $21,000 in pocket at the end of the day. Okay. If it's been paid out from the class version as a capital, where it's been earned as a capital gain, we don't pay a dividend, we pay 2 dividends, right? We pay $20,000, that's a non-eligible dividend, that's $9,000 of tax. The other $25,000 goes out tax-free as a capital dividend. More on the mechanics of that in a second, but obviously that's very powerful, right? Add all together, we've got $35,000. We are $14,000 ahead, having used the class version. And this repeats, of course, each and every year. Right? So corporate class works for my non-registered account. It works for your clients that are investing via their private corporations. Back to this capital dividend. It's referred to as the capital dividend account. Now, it's a notional account, I should say. Like, there's no cash in the bank. And what we're showing here is on a $100 capital gain, we have on the left what happens within the corporation, on the right, the shareholder. The top half is the taxable portion, the bottom half, the non-taxable portion. So and we're using the same tax rates as we had in the previous example. Our $100 capital gain, $50 is taxed. We pay some tax. We get some back when we pay a dividend, pay further tax at the personal level. It's the non-taxable portion that goes into the capital dividend account. Again, it's a notional account. It's just a spreadsheet that the corporation's tax accountant takes care of. But this amount can be paid out tax-free. There's no tax on this. Add it all together, out of our original $100, we've got $72. Now, you'd never pay a $50 capital a capital dividend, you'd never pay a $500 capital dividend. Why? Because the corporation's tax accountant needs to be involved. There are calculations. They need to do an election that needs to be filed with CRA prior to paying a capital dividend. So this is all going to cost money, right? Probably you wouldn't even do a $5,000 capital dividend, but in our previous example, it was $25,000. That's worth doing, right? And if it's a smaller invested amount, and we're getting $5,000 a year of going into the capital dividend account, maybe you do it every other year or every third year, right? So because you only want to incur those accountant costs once the balance has gotten sufficiently high. So this is also covered in our brochure, and again, client friendly for your corporations that have their own private corporations. I'm going to pause there so I can get some water and see if anyone has any questions. Okay, let's move along. We're going to switch gears now, and we will talk about what we call tax smart cash flow. This is near and dear to Fidelity's heart because we invented this, right? As Gracie mentioned, we won an Innovation of the Year award back in 2002 for this. But it's widely available across the investment funds industry. And it should always be thought of as a tax deferral. So what we're thinking about is the client who invests with you, maybe they've maxed out their RSP and TFSA, and they've invested $500,000 in a taxable account over the last decade of their working career. They retire, it's worth $1 million, they need cash flow, right? They can sell some of those investments every month, but that's going to trigger capital gains. Instead, they can use tax smart cash flow. On this slide, we call it an automatic monthly withdrawal program. What's really happening, though, is it's a distribution, okay? And we are paying out either 5% or 8%. Now, it's never exactly 5% or 8%. And notwithstanding the cruise ship and the private island, it's not yield, it is not return, it is a rate of cash flow. Your client is still invested in the same investment fund that they built up that capital gain in. Okay? And we can customize these to a good degree as well. I like the faucet here because just think of it like your client's being invested in the fund and we're turning on cash flow with that faucet, right? And you can do a whole range of options for your clients. Why does it work? Well, what we're doing is we're giving them back their own investment capital. And on a return of capital, the tax rate is 0. Now, there's a trade-off that I'll get to in a moment, but obviously that's pretty attractive, right? So that's what we're taking advantage of. Now, here's an example of the 5% option in action. And what we're looking at is a $1 million investment made back in 2008, and we're using the 5% option, Series F5 in this case. So that's on $1 million, that's $50,000. That's about $4,000 a month. That is these light blue bars across the bottom, right-hand scale. Now, we also have the dark blue line that is the value of the investment account. What you'll notice is it went down very dramatically early on in this process because we hit the financial crisis, right? This portfolio, this is a global balanced class, in fact, this portfolio lost over 30% very quickly. Okay? So in order to keep those distributions close to 5%, again, never exactly, we had to cut them because the market value was down. But, you know, the markets eventually recovered and we were able to build those distributions back up over time. And, and what you can see is at the end of this period, we actually have a little bit more than $1 million in the investment account. And that's after all of these years of pulling out cash flow. So even though it was a terrible time to invest, it worked out not too badly. Now, remember I said there's a trade-off? When we pay out a return of capital to a client, that reduces their adjusted cost base. It will go down over time. right? So we need to keep that in mind. That is how the tax deferral is achieved. So why wouldn't CRA shut this down? Well, I think the answer is sometimes people don't use tax deferrals wisely. In fact, this is a bad use of, this is an example of a bad use of a tax deferral. Because early on, we're actually underwater, right? We are deferring a capital loss. We would be better off selling $4,000 a month of this investment because we'd be triggering a loss. I can't think of a scenario where it's a good idea to defer, to use T-Series when we're in a loss position. Then we get back into a gain position. That's when we start to use T-Series. Okay. Now, sometimes clients don't like these distributions being, adjusted from time to time. Some clients like it, some don't. For the ones who don't, we have what's called the stable cash flow option. You tell us they want $3,000 a month, we can achieve that. Right? We use the F8 investment option, and we reinvest the difference. So if the F8 option was paying, $6,200 a month initially, and then after a year, so what happens is we pay $3,000 out in cash, we reinvest $3,200, and then the distribution's cut to $5,500 because the markets have gone down. We still pay $3,000 in cash. We reinvest the $2,500 difference. So we're able to achieve that stable value cash flow. And because we've taken out less over the time period, we've got even more in the investment account. Okay. Now, back to my original scenario where they invest with you over a decade, the 500,000 grows to $1 million. That's where T-Series really makes a lot of sense, right? So this is my scenario. They built up the gain, they retire, they start to turn on the cash flow, and they're using the stable value cash flow. And at some point, they look at the value of their investment account and say, hey, you know what? I'd like some more cash flow, so let's bump it up. Even here, it may not necessarily make sense to use tax smart cash flow T-Series. Think about the scenario where early on, your client's 62, and so they've just retired. They haven't turned their RSP into a RIF. They haven't started CPP. They can't start old age security. They can be quite well off and not have a lot of taxable income. That's probably the wrong time to be deferring taxes because they're in a low tax bracket. But then they're going to start that RSP and CPP and old age security, and maybe they are subject to the OAS clawback. That's when T-Series really makes sense, when they're in a high marginal tax situation. Right? Even there, we want to think about that ACB getting to zero. But if they're in a moderate tax bracket and, you want to think about the estate planning scenario, right? Because ultimately the gain does have to be dealt with. Even there, as long as we have a good long time horizon, even if their tax bracket right now is moderate and the estate will end up with a high tax rate because, say, they have a RIF of $300,000, $400,000 at the time of death and no surviving spouse, right? Even there, we can win. Why? The power of compounding. We'd rather have the money sitting in your client's account than CRA's. Now, that ACB, ultimately, it's going to hit zero. What happens? Well, the do-nothing option means we continue to get those payments. Okay, so what happens? Well, they're considered to be capital gains at that time. So still tax preferred in nature with the 50% inclusion rate, but they have to start paying some taxes. They can stop those payments, right? What they're doing is switching from the T-Series, we'll call it F5, back to the regular series, call it F. And you can go from F to F5 or F5 to F within the same investment fund. It's tax deferred. We do not trigger the gain. Okay, so that's what I mean by stop those tax smart cash flow payments. That assumes they have some other source of cash flow, of course. And finally, we do have the opportunity to take advantage of what's called a charitable gifting strategy. So we have a whole slide on this, and it's covered in our brochure. But rather than go through this slide, I'm going to tell you what I've done. So 3 years ago, in my taxable account, I had a class fund that was worth $20,000 with a $10,000 adjusted cost base. I turned on the 8% T-Series. Now, I'm still employed, so I don't need that cash flow. I'm having it redirected into another class fund. What I'm trying to do is deliberately draw down my adjusted cost base. I'm shifting adjusted cost base from the original fund to another fund. Right? Now, it's a tax-deferred switch. Now, I don't describe it that way to CRA, but that's effectively what's happening. All right. So my plan had been that I would let this draw down over time, get that ACB down to zero. Let's say it's still worth $20,000, and let's say that's 3 or 4 years from now. And then let's say at that time I want to donate $3,000 to a charity. Well, I could donate cash. Okay, but let's think about this investment. I want to donate $3,000 from this investment. I could sell $3,000 of this investment and then donate the $3,000 of cash. But that's going to trigger a $3,000 capital gain, because remember, my ACB is now down to zero. So I'm going to pay capital gains tax. I'm going to get my $3,000 charitable donation receipt. The better way to do it, of course, is to donate that investment fund, $3,000 of that investment fund, directly to the charity. And what that does, technically it still triggers a capital gain, but the inclusion rate is zero. I don't have to pay the capital gains tax. I still get my charitable donation receipt to use on my tax return for $3,000. It is the most tax efficient way to do charitable gifting. Now, you may have noticed I said that was my plan. This past December, I decided it was time to make a $3,000 donation to a particular charity. And thought, well, my ACB hasn't gone down to zero. On the other hand, the portfolio manager, after 3 years of using the 8% T-Series, the fund was actually up. It was actually worth $25,000. So portfolio manager had done a great job. ACB's down to, let's call it $8,000. So I could have sold $3,000 of this investment fund, but again, I'd pay some tax. In that case, I would have triggered a capital gain of about $2,000. So I told the back office to give $3,000 of this investment fund directly to the charity. The charity has a form to fill out on its website. Fill out the form. It's not very difficult. You give it to the back office. They're off to the races. Right? It was easy. It was easy. And now I actually also happen to have $3,000 of cash sitting in a bank account that I could have donated. I take that $3,000. I buy more investments. I bumped up my ACB. Right? So it's just a way more tax efficient way to do that charitable gifting. And it was easy. Again, the most tax efficient way for clients to do charitable gifting. It takes a few years, right? But it's a great plan. So if you have any client that is interested in even modest charitable gifting, you should be talking to them about this. Right? And clients that are looking to do bigger charitable donations down the road, it's a wonderful business building opportunity for you. Gracie, that brings us to the end of the presentation. We have a few minutes if there's any questions people want to throw at me at this time.
Perfect. Thank you so much, Peter, for an insightful session. Joan, do you have any additional questions for the TaxSmart solutions?
Well, actually, for the class fund distributions, so there will be 2 distribution dates for Fidelity class funds, right? So, what's the difference between those 2 distributions?
So we will pay capital gains dividends in January. Again, treated as capital gains, so 50% inclusion rate, and also gives a full year of opportunity for tax loss harvesting if need be. And Canadian dividends will be paid in May, and they tend to be small, right? The capital gains dividends tend to be lumpy, right? Didn't pay any in 2024, none in 2025. Might have a sizable one in 2026. We don't know yet. Too early to say. So they tend to be lumpy. The Canadian dividends that are paid in May, they tend to be small. right? But regular. So even something like global income class does pay Canadian dividends because a small proportion of its investments are into Canadian equities that are paying dividends. So you will have some small amount, but it's going to be tiny, right? I just wonder if I go back to that slide, just bear with me. Where is it here? Yeah. Here it is. Just share it again. Right. So the Canadian dividends, you can see they're tiny, right?
Yeah.
You know, 2022, 0.19%, 0.35, 0.26% of NAV. So they're small. If you own a Canadian equity class fund, it's going to be larger, right? So it depends on the holdings of the Canadian dividends. But again, it's tax preferred in nature. So it's certainly better than earning interest or foreign income. Okay.
So also the capital gain distribution is also smaller than the trust funds, right?
Typically,
Typically.
they are, okay, if I turn on my annotation here, typically, you know, they're smaller in the class version than they are in the trust version. But in any 1 year, or sorry, that's the wrong line. The class version capital gains are this line that I've got my cursor against. They're this line on the trust version. And you can see, you know, it varies from year to year, right? In 2022 and 2023, we actually paid more. We actually paid something in the class version, nothing in the trust version. But you go back to 2020 and 2021, it was flipped around, right? And 2024, again, flipped around. We had about 0.5% of NAV distribution of capital gains on the trust version, nothing on the class version. And 2025, again, it's going to be nothing on the class version.
So one more question is about the distribution. So once it's distributed, will the client be notified? So they have the time, you know, or this time they have a capital gain, they have to think about do that.
So a couple of things there. We do issue a notice to advisors.
Okay.
That's about a week or so, maybe a bit more than that, in advance of paying capital gains dividends. So in January next year, for instance, if we're paying a capital gains dividend, you would see a notice that there's going to be a payment of capital gains dividend. You would also, it would show up on the statement as well, right? I should also say that typically they're reinvested, right? Which means it bumps up the cost base. So it really is about a timing difference.
Okay.
Right. So if you have a client who puts $100,000 in and they get a $10,000 capital gains dividend in January, yes, they have to pay the tax on that. So that would be about $2,500 of tax, but it's reinvested. So their cost base would go up to 110, meaning that the disposition, the gain on disposition when they ultimately sold is accordingly lower.
Any additional questions? Okay, perfect. I'll take silent as a good sign. Okay. Yeah, thank you all for taking the time to join the meeting today, and special thanks to Peter for an insightful session as always. So I also wanted to note that we're able to combine corporate class and T-series strategies to help maximize the tax efficiency for clients non-registered or corporate accounts. And if you have any additional questions, or if you like to discuss a very specific client case that may be a good fit for Fidelity TaxSmart Solutions, please don't hesitate to reach out to me or Tara, and we're here to support. And thanks again, and I hope you have a great rest of your day. Take care.
Thank you.
Bye.
Thank you, Gracie.
Thank you. Bye.